Bank failures, inflation, rate hikes, market volatility. Wow, there is a lot going on right now. So, to all of you clients joining us here today, welcome to this month's Capital Markets Update and Outlook call. We are live online on our website, investwithccg.com, as well as on Facebook, LinkedIn, Twitter, and now YouTube, and now Twitter as well. If you are joining us here live today, welcome. Thank you for being here. If you are watching in the recording, welcome to you as well. Thank you also for taking a little bit of time out of your busy schedule to join us here today. If you are joining us for the very first time, welcome to you as well. My name is Eric Hagan. I'm a financial advisor, and I am president of Capital Consulting Group, or CCG. CCG consists of myself, of Chief Investment Officer Tom Fox, who you will hear from in a few minutes, financial advisors Dan Oshman and Rana Grant. If you are guests of Dan and Rana, welcome. A special welcome to you as well. And then we also have our client support team, John Knutson and Marilyn Westmark. Together, our goal is to help you make your next financial decision and the one after that a good one. That is the secret to prosperity. We do that in two primary ways. One, we can help you see your entire financial situation, both today as well as every year into the future, through our personal wealth planning services. If you have any questions about your financial future, personal wealth planning is how you get your answers. If you'd like to learn more about this service, you can go to clearfinancialfuture.com after today's message, of course, and watch the 2-minute video. And then second, we help people get and stay invested right. Right is what's right for one person is not right for the next. And so Smart Mix is our personalized portfolio solution for individual investors. If you would like to learn more about our personalized approach, you can do that as well by visiting smartmixportfolios.com. We have a busy education calendar coming up. If you're not aware, we have 3 presentations I'm going to highlight here today. Next week, we have how tax planning changes through 4 stages of retirement. We also have in April what baby boomers need to know about their retirement income. If you are in your later 50s, early 60s, and you have not turned on your Social Security income yet, that is a must-attend presentation. There are a lot of factors that go into that decision of how and when to take Social Security. So I highly recommend you pay attention to that presentation. And then looking all the way out there into May, we have an estate planning presentation called How to Plan, Communicate, and Execute the Smooth Transfer of Assets and Values from One Generation to the Next. We focus on the valuables, but we also focus on the values. So a very comprehensive presentation there as well. We keep our finger on the pulse of the markets and the economy. Every Monday, I broadcast live on our website, as well as on different social media, looking at what happened in the markets the previous week. And then later on that day, if you can't join me live in the morning, I do send an email with a link back to the recording. Usually comes out about 3 o'clock Central Time. So if you are not subscribed to that and you would like to get that email, you can go subscribe at our website, investwithccg.com. All right, with that, I'm going to introduce our Chief Investment Officer, Tom Fox. Tom is going to review where we are in the markets, kind of give us a look at the headwinds, the positives, look at 2023, where we're at, where we're headed. Ultimately, this is your opportunity to kind of look over our shoulder, get an idea of what we're seeing in the markets and the economy, what we're watching for. Tom has a very impressive resume. As you can see on the screen here, he spends all of his time more behind the scenes doing market research, due diligence, running different analyses, really focusing his attention on the economy and the markets. If you're watching online live with us, feel free to use the chat boxes to submit any questions that you have. If you're watching in the recording and you have any questions, we'd love to field those questions. You can submit those to me at my email there on the screen. So as Tom is presenting, go ahead and submit those questions in the chat boxes. I will be watching that, and I will bring that to Tom at the end. So with that, I will bring Tom on here, and here we go. Welcome, Tom. Thank you for being here.
Good morning, everybody. It's good to be with you once again. And I'm very excited actually for this presentation because we've got a lot going on in the economy and in finance. And many of you are aware of that. There's been a lot of fear out there, especially with um, the Silicon Valley Bank going down, and then another bank went down, and then the fear is that there's going to be a lot more of them. Is it a contagion? So we're going to talk about that. We've got a lot to talk about. And again, our theme for this year in 2023 is wag the dog. And what does that mean? That means something of lesser influence moves something of greater influence. And of course, the dog is the Federal Reserve Board. What's going to cause them to stop their interest rate hikes and actually maybe even lower interest rates? Because our whole economy is depending on what those interest rates end up being. So we're going to talk about that. And we have an introduction of something we weren't expecting. And that is something broke. And what that breaking was, we're going to talk a lot about this, but it is when Silicon Valley Bank on the West Coast went down. And we'll talk more about that. Okay, so I like to start off with every presentation with, hey, there's a wall of worry. Stock markets always climb a wall of worries. And what are other strategists saying? And I'm not a little corner in a little box, in a little room by myself. So I do pay attention. I read research from many, many very smart firms that are very good at research. And then we come up, after digesting everything and my own analysis, we come up with what we think is going to happen versus the rest of the strategists out there. Now, sometimes we're in agreement, sometimes we're not. So we're not standing on an island by ourselves. We are certainly aware of what's going on out there. So last week, if you remember Paul, in his speech to the Republicans and Democrats, said that we may raise rates 50 basis points. It's going to be data driven, but we may end up possibly going 50 basis points, and we're going to be higher for longer. That was last week. And then on Friday, something happened. The first breaking of the fast interest rate hikes began to take hold and began to bite. And all of a sudden, we had a very large bank, Silicon Valley Bank, go down, and they were unable to meet the liquidity needs. Now, what happened there? What happened was that Silicon Valley, back when the rates were low, were getting large amounts of deposits, and they need to invest that money because they're going to pay out a certain amount of yield. So they need to make more, which gives them the profitability of the bank. But what happened was they were forced to go up the ladder in duration or maturities and buy longer term bonds. And that looked good for a while because when you buy them, they're at par of when you enter. And so they needed to try to stretch for yield. Other banks who are not in trouble didn't stretch for the long maturity yields. They stayed maybe in the intermediate to short term. They lowered their profit, but some banks, because of their management or whatever they were doing, a risk taking, they added risk by going out longer in the maturity. Then comes the Fed on their interest rate narrative, and they're on this plan to raise rates fast, second fastest in history. They've raised rates. So we've seen the rates go up significantly. They were raising 3/4 at a time, then 50, and then 25. So they've been raising rates at really an unprecedented speed. But what happens to the Silicon Valley Bank? Well, they're invested in longer term treasuries or corporates. And what happens when you raise rates fast? Those bonds lose their value. Because remember, as yields go up, bond prices go down. And so it's fine if you don't have to liquidate or if you don't have to sell the bonds because you can wait until a full cycle comes around. But that's not what happened. Some depositors started removing money from the bank. What does that mean? They got to go into their pool of longer duration bonds and sell them at a huge loss. And so As that began to unfold and liquidity needs began to go up, they had to keep selling more underwater bond portfolio. And so that took place. And then it got to the point where they were no longer had enough liquidity and they needed to call the banking feds to come in and to help them. And of course, initially, there were many companies that had money there that had one company had over $1 billion at their bank. And remember, FDIC historically has only guaranteed or insured 250,000. Well, what would that mean? They could lose $1 billion of their funds. And so the feds and the Treasury decided and looked at it and said, if we bankrupt all these companies that employ people, it's going to cause a huge economic, perhaps disaster. So the Fed stepped in and said, hey, we're not going to only guarantee to 250,000, but we're going to guarantee this to no matter how much money you have in there. So that was a big change, and it was all needed to keep a major crisis from happening. But still, if you own stock in the bank, or you own, if you're a shareholder, your shares go to zero. So you can lose all your money. And so when the bank takes over, the shareholders get zero. And so if you were invested in that, and maybe you're in some other banks, regional banks, or some other banks that may have a liquidity problem as well, maybe they went out and invested the same way that Silicon Valley went out and bought longer term treasuries or corporates to enhance their profitability short term and took more risk. There's other banks out there. So that's still a ongoing concern. Now, what would cause a continuation of this is if people with deposits in the bank decided to move their money out of these banks, because they got to come up with the money to pay them off, and they're going to have to go into their bond pool, which is underwater. And that could happen, and I think it's going to happen in a more a greater degree. We don't know exactly, but we think that's going to continue to happen. So what's happening? Many strategists are saying, hey, there's a deep recession. The odds of a deep recession are increasing with all that's going on. The banking crisis will expand, as we've been talking about, and then there could be another shoe dropping, and that is that there could be if bonds, especially high yield bonds, begin to go under, there could be another crisis, a liquidity crisis, because maybe some people weren't in treasuries or high quality corporates. Maybe they're in a lower rated corporate bonds. Are more riskful. That's another. BlackRock's chairman of the board said that could be another shoe that may drop. We're watching that very closely. So we got the banking crisis. We got maybe another shoe dropping. We don't know if that's going to happen. And then we have the economic data showing the decline in inflation is going to be a hard-fought battle. And the Fed is saying, hey, we still want to go for 2%. We think, and many other analysts think, that's going to be hard. And I think that we're more bullish on that. But there are many analysts that think that it's going to be a hard-fought battle, which means they're going to have to keep rates higher for longer. And that's what the Fed said last week. Now, the economic data, again, shows that it's going to be hard fought. And then you get corporate earnings. A number of the revisions recently have been dropping fast. What the expectation is for corporate earnings and profitability of companies in the next quarter and the following companies. We'll look at what we think in the next slide, but that's what they're worried about. Hey, that corporate earnings are going to drop. And so therefore the valuation of stocks is going to drop alongside of that. So the upside potential for the S&P 500 appears limited at best, while considering all the downside risk that remains. And so that's what strategists are saying. And of course, the start of the year market rally, we hear this was only temporary. Remember, we had a great start to the year, and we're heading lower. That was just an aberration. It's not going to continue and follow through to the end of the year. So there's growing negatives. Many think that all that's out there today is not fully priced into stocks, which means stocks will go lower. And so overall, strategists have deep skepticism. There's a lot of bears out there. Many strategists and hedge fund managers believe we're going to go to lower lows than we had last year in October, which was the low. So that's the a big wall of worry. It's a lot to worry about. But let's look at, are there some positives? So here are some positives, and we're more in this camp. The February data shows that deflationary trend back on track. Remember, the CPI just came out for February, and maybe January's bump up, which caused the market to pull back, was just an aberration, and we're back on a deflationary trend. We think that is true, that now the inflation rate is back going down like it had for many previous months, and then we believe that's going to continue. That's very bullish. Core inflation is falling faster than the Fed and consensus expects. So many people were expecting it not to come down this fast, but it does appear that it's going faster than what the Fed was expecting. And that's why they were saying a few weeks or last week, beginning of last week, that, hey, we think that we're going to have to go higher in interest rates and stay high for longer. Now, we think that's all disrupted, and we'll talk about that. Wage inflation, here's another bullish item, is already approaching 3.5% target of Fed. That was their target. We're getting close to that. And that's a big wish list and we're going to see a chart on that. That's a big wish list for the Fed. It's starting to come down and roll over. That's another inflationary in terms of wages paid. So that's another item the Fed's worried about, but now it's going in the right direction. So the bond market already sees deflation. What's interesting is where the yields are. If you look at a 10-year yield, it was over 4% just a few weeks ago. Now it's around 3.39, which is a huge drop. It's changing every day, but it's dropping like a rock, which means that the bond market is saying, hey, we're not going into more inflation, we're going into deflation, and the Fed is going to be forced to lower rates. So we do believe that the banking crisis, something broke, will lower employment and inflation and achieve the Fed's goal, because really what they wanted is starting to happen. And so this is going to achieve the Fed's goal without raising rates more. That's where what we think is going to happen. The economy remains resilient. We'll look at some of that. Employment remains resilient. Corporate earnings were mixed in the fourth quarter. Remember, a lot of strategists said that we're going to have a corporate earnings recession. That has not occurred. No disaster coming in coming quarters. We think it's going to come down, but it will not be a disaster. So we're in that camp. And then strong beginning S&P 500, which we had. When you look historically, when you've had a down year and a good beginning, you have a great first half and second half. So, and it's a high probability that when we had the beginning that we had this year following a negative year, there's a high probability that we're going to have a strong stock market this year. So we believe stock market is inexpensive. We think the downside is limited, and we have seen the bottom. We don't think we're going to go back to the October lows. Now, we believe that because of where the unemployment is, and we're going to look at some charts on that. But first, let's look at the banking crisis. Fed monetary policy finally biting. Something broke, and they can take their foot off the gas. Now, this is what's going on at Silicon Valley. You can see on that, I don't know, you may not be able to see that. So if the Fed continues to raise rates, it's going to get worse, not only for Silicon Valley's portfolio, which was taken over by the Fed, it's going to get worse for other banks. Savings will dwindle, employment softens, and everything can get really bad. So if the Fed goes off the rocker and ends up raising rates and keeps raising rates, they're going to cause a deep recession. We don't think they will. This is why we say wag the dog, but now we have a new wag, and that is the banking crisis. And you can see in the bottom chart, You can see the bars were mainly positive, and then they went negative. That's banking losses on their portfolios. And so what will happen if the Fed continues to raise rates? This was for Silicon Valley, but it could be for many other banks. You're going to see if they continue to raise rates, they're going to have bigger losses in their portfolio. And if they get any kind of liquidity squeeze, they're going to have to call for the Fed to come in. This would be a disaster. We don't think the Fed is going to, I believe they're going to abandon their rate hikes, and we'll look at that later. So how much has the outlook by strategists changed, investors have changed regarding the Fed expectation going forward? Well, this is saying, you can see the red dotted line going across. That's the current Fed funds rate. You can see the gray line fall off and go from over 5%, 5.58, down to 4%. That's a huge expectation change. Now, this is what happened with the banking crisis that's going on. What does that tell you? That tells you that by the end of, if you look at the calendar at the bottom, that's December, that there is now a probability that the Fed are going to have to lower rates by the end of the year. This is look how high the bar was when it hit 5.56. That's before the banking crisis. And maybe he can circle that or highlight that. There it is. But look what happened after the banking crisis that we just went through. Boom. That's saying that the Fed is going to be forced not just to raise rates, but to lower rates. Now, that was certainly not on the table just a week ago. Now, if you look at it, remember the expectation was for a 50 basis points, a 50 basis point rise. Now we're back to 25 basis point for this March. This is next week, and 25 basis points in May. They don't meet in April, so they'll meet in March and they'll meet in May. So they're expecting, they went from 50 basis points and then dropped down to 25. We don't think that's going to happen. We still think that's too high. Now, if you look at this chart, this is looking at it at a different angle. There is a 33% chance now of no hike next week. There was zero beforehand. It went to 33% chance of no hike next week when they meet, and an 80% chance of no hike in April or May, excuse me. So you can see that what's happening here is that a lot of investors have changed everything in their outlook, and they're saying, hey, the Fed's going to be forced to stop raising rates and maybe even lower them. Now, this is what the Fed is going to be afraid of, and the government deposits moving out of smaller banks. And if you look, there was a survey that was done. I think it was on Facebook or Twitter, excuse me. They took and they said how many people are moving their funds out of the smaller banks. 12.4 said we've already moved. So the small banks have already lost 12.4% of the deposits. They need to come up with that money by selling a bond portfolio at losses. This is the concerning thing. And the other in the poll was how many are going to move. That was another 26.2%. Now that's a lot of money. We're talking about 38, 39%, or almost 40% leaving the small banks and going to bigger banks. If that happens, that's going to be, then these small banks are going to have to sell their bond portfolios that are underwater. They're not going to have the liquidity, and there's going to be more bankruptcy coming for banks. Now, that's a high probability right now. Now, there were 43% that said, hey, their funds are safe. The government's going to back them. No matter what happens, I'm okay. And then, of course, there's 18% that have no idea. Should I be concerned? Those are the people that don't really watch it at all. And then there's a lot of people like that that don't really care. That's why you give your money to professionals like Eric Hagen. All right, stocks setting up for a second half rally. We think that's going to happen. Now, this is where the PE ratio is distorted by higher multiples on FANG, but stocks overall are cheap. Even FANG stocks are cheap, but you can see that if you take the FANG PE ratio, and the FANG, what is the FANG? Facebook, Apple, Amazon, Netflix, and Google. If you take those stocks, which are higher PE stocks, out, we're down to a 14.3 valuation. That's cheap, hardly demanding. So we think that stocks are cheap already, and we think there's a lot of room for the PE ratio to go up. Now, also, when you look at historical bear markets, where are we today in the duration of the average? And you can see if you look over on the right side, you got the gold colored bar versus the blue. The blue are the historical bear markets. How long do they go? And you can see we're getting really close to the average duration of our current bear market. So what that tells me is that there's another business cycle coming. There'll be another expansion. We've been in not expanding. We've been going down, but now I believe we're at the cusp of another expansion in the economy and the stock market. Now it's out a little ways, but remember, stocks move before a recession is finished. So if we go into let's say that, I know we haven't been in a recession yet. Many people have called for it, but we haven't been in it yet. We forecasted that we might go into a soft recession. We either said a soft landing in the economy or soft recession. If we go into a soft recession, it may not even move the stock market much at all. Now, remember, this doesn't necessarily say where the stocks are going to go, because the stocks can go up even if we do fall into a mild recession. Now, if we go into a deep recession, which is not our outlook, then stocks will fall. But we haven't been in one yet. We think there's a growing chance of a soft recession, but stocks can still go up in a recession, especially if it doesn't go deep. Now, the economy, we're just going to look at a couple charts. This is a really good chart. If you look at the bottom red line, this is the unemployment rate as compared to other bear market periods. Now, look at all of them had much higher unemployment. You can see even two of them were over 9%. You can see where this one is an unusual bear market because employment has not been touched. Well, what does this say? This says that this is a different bear market. That's why we are in the camp that we could still do a soft landing or maybe a very mild recession because of the unemployment. Now, unemployment begins to ratchet up and go like the Fed raising rates. If that begins to happen, then we could go into maybe a mid recession. But this is the reason that we have some confidence that we have a backstop. And there's still a lot of companies looking for employees. There's more jobs than people that are willing to work. And that's why we're at a 50-year low here. And so you can see here, this is the backstop to this particular bear market. Also, this is another big one regarding deflation. Remember, we saw the CPI come down and continued its deflationary path. This last announcement for February. But this is the Fed's wish list. This is a big one. They want to see wage growth come down. Now you can see it's rolling over hard, and we think it's going to continue, that wage growth is going to deaccelerate, and this would really impact the Fed's decision making. This is a bullish chart. All right, so what is our outlook? We've kind of touched on it as I've gone through this presentation. This is the outlook. The theme, again, is wag the dog. Now we have two wags possibly. We've got falling inflation is one wag, and now we got the bank failures or even more failures coming. Shifts Fed to pivot earlier than expected. Now it's going to be the narrative of Powell next week is going to be very, very interesting because now he has to he's against a rock and a hard place. They would like the inflation to come down, but now there's things in the economy that are breaking. So he has to really think through whether or not they're going to raise rates anymore. Now we're looking maybe we'll just go through these. We expect increase in volatility in the first half. We expect the banking crisis to most likely expand, possible another shoe to drop. Bank crisis will increase unemployment. So we think that unemployment number is going to go up, which will put wage downward pressure on wages. We think the lower inflation and the lowering needs for rate hikes. So we think that this new banking crisis, along with deflation, is going to cause the Fed to stop earlier. And we're expecting, again, as I've mentioned, soft landing or soft recession in 23, no deep recession. We don't see that yet. Now, there's some things could change, but this is where we are right now. We expect corporate earnings to come down, but we do not expect a crisis. We think that the economy is strong enough, employment strong enough, that we do not expect an overall crisis in earnings. Now, it's sector by sector, company by company. Some companies will not do well, but others we think will surprise to the upside. And then once the Fed stops at rate hikes, we think that's going to happen very soon. Markets should start to rally to the end of the year because that's what the whole reason the market went into a bear market last year, and the whole reason it's kind of stagnant right now is because of fear of raising rates and holding longer. Now everything's changed. And so we'll see what the Powell says next week. That's going to be, if you have nothing else to do, you want to hear Powell's testimony, it's going to be a big one to see what their thinking is and what they're going to do. Now, we do not think they're going to stop raising rates. We think they're going to go one more quarter, but we think in the narrative this next week that they're going to say, hey, we're going to put it on hold and just see how it impacts the going forward. That is a very bullish. If that narrative comes out that we're not going to raise rates anymore, boom, stocks are going to go up. Remember, stocks go in a different direction than maybe the overall economy. They can. So lots of cash on the sidelines still. There's a lot of negative and bearish people out there. We're expecting a strong second half rally. We believe the first half markets are going to remain volatile. Eric, we've been talking about this, 2 steps forward, 1 step back in the stock market. We expect that 1 step back. So you got to be patient, but it will be 2 forward and 1 back. And then, of course, what is my forecast? I haven't changed it. Still looking at 4,600 by the end of the year, which would be a pretty big rally. And we think it's more going to happen in the second half. It could begin, though, if the Fed says we're holding rates where they are.
Excellent. Wonderful. Thank you, Tom. I am watching various chat boxes here. I don't have any questions at the moment. I do see a number of you out there. So if you have any questions, now's your opportunity. Go ahead and drop it in the chat box. Would love to field any questions. I do have one for you to think about that came from someone the other day regarding earnings. And it's kind of a twofold question. And it has to do with earnings expectations and what companies are going to be putting out there for what they expect moving forward. The question is, should we expect that they're going to forecast and have their outlook be more negative than otherwise because they essentially have permission to do that? And if so, what could that do to the markets?
Well, that's an individual stock by individual stock basis. Some stocks will not have that outlook. Some will. So the ones that will, that means the stock typically, they look at their earnings and where are their earnings, but if they're out, they always look at the narrative of the outlook. So when you get let's say they even beat on earnings, it's their outlook that most people look at on top of the earnings announcement. And so usually if they say, hey, we're expecting lower sales, lower revenue, or whatever, then the stock will drop even if they beat in revenue and earnings. So that brings stocks down, but that's really a stock by stock, sector by sector, situation. So it's not. We don't think that's going to happen broadly. It's not going to be all stocks will say that, but it does lower the stock price if they announce that. And we are seeing some analysts are revising downward, but analysts, they're either right or they're wrong. They've been wrong a lot, so we'll see.
Well,
Because
and
how many
to your
times,
point, we've
like
had such a
like
wide.
this wide range of analyst outlooks, and then how many times? Well, 80% or 75% beat the analyst expectation. So even though they're lowering revision, I don't trust them. There hasn't been too many analysts that have been right.
Good point. Harder to be right when you have so many different opinions out there as we do
Yes,
today,
right. Yes.
right? Well, I don't see any other questions coming in, so I think that's a sign of a job well done as usual, Tom. So thank you very much for that. Appreciate the objective analysis of everything that's going on, trying to make sense of all these different moving parts. So thank you, everybody, for being here. If you do have a question, I'll give it another few seconds here, and we can field it for you. But again, we will say thank you very much as we look forward. We do have the next 3 monthly presentations. As a reminder, we do this every month. We want you to be in the know. We are paying very close attention, particularly Tom, 24/7 looking at this stuff. And this is, again, your opportunity to look over our shoulder. So mark your calendar. We are back here again April 13th, May 18th, and June 22nd. So we're out the next 3 months here, the second quarter. All of those are on the website. You can go drop in your name and email. You'll get a reminder email ahead of those so you don't miss out. Of course, they are all recorded. I also, after the presentation, put together this kind of brief summary report. So if you want the Cliff Notes, I'll have that on the website here, hopefully sometime later on today. With that, I'll check the question box here, chat boxes one more time. No questions. Tom, anything else you want to close with?
Yeah, I would be patient. We are watching it very closely. If there's more shoes to drop, we'll evaluate those if they come. And it's hard to predict that. Nobody predicted that I'm aware of. Maybe you watch cable news. I did not see anybody say the bond portfolios of these banks are underwater big time. We didn't hear that. And that's a little concerning why we didn't have more heads up on that. Even I didn't, and I'm a strategist. So, and obviously many people didn't because it was like a new news. So there is a potential for that. But I want you to know we are watching that, and we will respond if we have to. We could get bearish, but we're not bearish right now. But we have our finger on the pulse.
Absolutely. Yeah. And I've listened to a number of other analysts, and in fact, that those same comments are being said this week. How did nobody see this coming? So it's pretty remarkable. So important to keep our finger on the pulse. So absolutely, Tom. Well said. All right. I don't see any other questions coming in, so I will go ahead and close up our call. Tom, as always, thank you so much. Really appreciate the analysis, and hope everybody has a wonderful rest of your day. Bye,
Thank
everybody.
you.